Alright, so how's it going? It's your boy, Outcast, G-Minor. And so I want to start something new, a YouTube channel where I'll go through once every so often, depending upon the flow of the market, probably like once every 3 days or once every 2 days, news events, weekends, all of that stuff. The main objective of this channel is to just track historical technical analysis so that I can watch back over a period of time and just like see the progression in growth, or like seeing the what's that word, consistency in my mistakes, or consistency in wins and wins, basically. So yeah, kind of new to this stuff, so yeah, not go perfect. Just by looking at the gold chart, what do I see? Well, basically price, I make a run on liquidity over here. And so that's basically price coming in, making a run on liquidity. All of the buy stops, then probably trigger a couple of them, and then just by looking at it, I have a few regions where I suspect price might come back in for a pullback. So yeah, those are the levels where I expect price to pull back after making a run on liquidity. So probably look something like this. Either come here, sweep the high, one out of the two, fill this, or option B, price comes in and then come back down here, one out of the two. And that's what I'm expecting. Let me just change the color of this bad boy real quick. Yellow. Alright. So simple as that. So how would I execute on this now? That's the real question. So if price comes up to that region right here, and I see it sweep the high, come back in, run the low, the level that the low was on. Once it pulls back in, I'm looking to go short. So let me see if I can make that a little more clean for you guys. So if price runs the high, comes back in, sweep the low, and then pull back, probably somewhere into like 50% of the move that came down, 50% to 70%, so like the halfway mark. I could get equal highs out of it. I'm not saying that price usually retraces in like 2 to 3 different ways. So this are usually model 1, model 2, sweep the highs, price come back in, fail to break the low, come back in, double tap, and then down again. One out of these two price actions I'm looking for to go short. How would I short it? Well, after price runs the high, comes back in, and then starts to retrace, I'd look for it to go at least 50% of the move, and then entry there, stops at the highs, target, stops at the highest, target at the first region. So this would be a good 3-to-1 trade. You can risk $19 in order to make 67, 190 to make 670, and so on. To trade like this, how do I execute on this one? Well, I go short on the equal highs. Stops about, what's that, 4 basis points, so I put it at 40. I put my stops at 4 basis points, so that's 40. And then take profit in the region. So yeah, that's basically how I would execute on the idea once it gets to the region that I'm looking for, and that's between 1920 and 1930. So anywhere between 1920 and 1940, I start to see some topping out price action where price fails to, how should I say, close in that region with a full body candle, not wicks. I'm not looking for wicks, I'm looking for full body candles. If we get that, then idea change. But if the price starts to wick anywhere in this region, then I'm bearish. Alright. I think I want to review this trade before I actually move on. So this was like a little trade that I was looking at yesterday, but I didn't take it. It's just for like technical analysis reasons. So price left the fair value gap, missing price, I don't know, whatever you guys want to call it. Fair value gap, missing price. Market came in first, tested it, failed to close at the region, but didn't break below, and then came in equal lows. So that was the first sign of bullish momentum. Then now we had a next fair value gap over here. That was used as the first. The market came in, gave us the first touch, gave us a second touch, and then price swooped off. But that's besides the point. What I want you to look at is that while all these lows are being created, price neglected the high, or I should say failed to break above the high. So that for me tells us that the market is bullish, because we haven't really tested the buy side liquidity as yet. We're building in sell side liquidity we're building in sell side liquidity basically. All right, so as you can see, the market keeps making lows, and then a higher low, while failing to create a higher high. So that to me shows me that some accumulation was being done in this region. The same thing here, the highs right here, and we kept on making lows, well, equal lows in a sense, before we started making higher lows and then took the high out. And the moment we took this high out, price never looked back. It just went off, kept on going. So basically, what I'm just saying this to say, if it's one thing in the market, just look for the fair value gaps. And you might ask, what is a fair value gap? Well, let me find a cheap way to describe it. So if you see the market going up like this without much impulses, then there ain't much fair value gaps in this. So the market has no reason to turn back, really and truly, because there's no missing price, there's no fair value gap, all that being filled on the way up. But if you see the market going up like this, and then it starts to get choppy at the top, then now you have two regions of fair value gap to work with. You have somewhere here. Let me change the color. You got somewhere in here to work with. You got somewhere in here to work with. Expecting price to come back in, fill before it moves off. Expecting price to come back in, fill before it moves off. So usually gonna see two types of trends in the market. I don't know if trends the right word or how the market moves. So basically, boom, 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 filling all the way up, and then impulse is on the way up, and then a slow chop before price turns back, fills some gaps, and then continues up. And vice versa for the bearish scenario. So let me just look at the dollar real quick. Yeah, so the dollar, how would I say now? Personally speaking, I'd like to say that I'm bullish. Reason being, I don't know. Personally speaking, I'd like to say that I'm bullish, being that all the liquidity is to the top side. All the liquidity is to the top side. The reason why I'm not 100% bullish as yet is because we haven't really filled the missing price really and truly. Like if I look on the 4-hour chart, zoom in, assess price. Yeah, like we haven't really came in and filled, unless you're gonna say, okay, this is the missing price right here. And then you can say, okay, the market actually came in and filled. So if we're going to work off that, then okay, the market has filled the missing price. Time to make a run on liquidity. One might say, where is the liquidity now? So just looking back, we just filled this missing price. The liquidity is going to be levels like, I'd like to say between here and here. Those are my levels of where I expect liquidity to be. So how do I expect to approach the market going into next week? Well, we can either have the market bounce up a bit, give us equal lows before shooting off to targets like that, or it could just randomly grind up into that region, leaving no missing price behind, and then climb higher, never stops. So that's just how I'm looking at the dollar, but I'm bullish short term. Bullish short term on the dollar. So when I mean short term, probably like a week, a trading week to 2 trading weeks basically. So that would bring us to about the 20th to the 27th of January basically. That's when I'm expecting to be wrong, if I am wrong. Let's look at the stock market. Clean this chart up real quick. On that lower time frame. So basically, the US 30 has little to no missing price really and truly, unless it's to the downside. Like most of it's being filled as we speak. Honestly, like I'd have to classify it from here, come right down to here. That's what I think. That's gonna be the fair value gap or the missing price that brings us down. This is where the buy stops are rested, in my opinion. So the market could, and I say could with a huge grain of salt, because you still have to take into consideration this price action here. But the reason why I'm not doing that, and we're on the weekly chart, fuck, my bad. Still remains the same basically, because we already broke above this set of liquidity right here. So honestly, I guess we're just gonna have to use a higher time frame liquidity, which is this region right here. I'm expecting the market to either A, tap in and then continue down, or B, run the highs and then continue down, take us to somewhere about here. Holy shit. Take us to somewhere about here. Somewhere in this missing price right here. So that's just my technical analysis. How would I trade it? Just like with the entry on gold or silver, I'd wait until it gets up to the region, wait for price to take out a low, set my stops at the high, and then let it run. I'm not saying price can't break down from where it currently is right now. I'm just saying you can get a way better sell at a higher price. Yeah, because there's not much, unless you're gonna say, okay, for the short term, because if you notice I'm on the 4-hour chart, the liquidity is right there. As you're gonna see, for the short term, the 4-hour chart, the liquidity is right there. How would price react? Well, I'm expecting price to run this low right here. This low right here. So once it breaks below this low, pulls back, I go short with my stops at the high, and then I target this region. Well, this region right here. And then I have my target set for down here. So short term, this is the trade that I'll be looking at for today, I guess, if the market has volatility. Let me change the color. So if the market has volatility, this is the trade that I'll be looking at going into next week, because I doubt this will play out in a day. Expecting price to run this low, pull back a little bit or somewhat, and then find this region right here. How would I set this trade up? Short there, stops there, or at the end of the range, and take profit right there. So that would be an easy, well, not really easy, but like that would be a 1 to 12 setup. You can risk $11 to make $149. You can risk $112. You can make $100. You can risk $118 to make $1,049. $1,491, and you can risk $1,000 and make 10 racks. So yeah, no, that would be 14 racks. So yeah, like, share, subscribe. If you want to see any other pairs looked at, you can comment. I'm pretty new to this, so what's that? Advice, criticism, all that's welcomed, to be honest. Yeah, so peace out, outcast out, G-Miner out, stay cyber.